Most people in concentrated liquidity are selecting their ranges based on vibes, like, oh, maybe I should do plus 5%, maybe I should do minus 5%. Others are using rules, but those rules are static. They're not dynamic based on the pool that you're investing into. So today, I'm going to show you a complete guide on range selection, and I'm not going to hold back anything. By the way, this is going to be the same exact range selection guide that I use with my $18,000 consulting clients over at my company, Builder Wealth. We're going to start off with Ethereum to USDC, and as always, you're going to be using Metrix Finance, which is the software company that I founded that helps you with all of your concentrated liquidity needs, and pretty soon we have a huge V4 update coming. Just make sure to subscribe to the channel with notifications turned on. But anyways, starting off, I want to show you on a crypto to stable and then a crypto to crypto pool, and then I'll leave it to you to do the rest basically. So the first thing that we look at is range time span. Range time span is basically going to determine how much data you are going to factor into your range. My typical rule of thumb is going to be 30 days of data, trying to be in range for 14 days. So typically you'll say, hey, I want to be in for an average of 2 weeks before I have to rebalance. That obviously determines how much time you're going to spend managing the pool and stuff like that and upkeep. But if I'm looking at 14 days, then we just multiply that by 2, which comes out to 28, but I just round up to 30 because why not? But basically when I'm looking at 30 days of data, I'm trying to factor in as much data in my range as possible. In other words, take a look at the price history here. I want to try to factor in all of this basically if I can. But we'll start at the 30-day high and the 30-day low for starters. And then from there, we'll start to refine. So going back to my framework, I also look at asset correlation. Now, more recently, we've kind of determined that correlation isn't the best rule of thumb, especially for a crypto to stable liquidity pool. And crypto to stable liquidity pools also have different functions like dollar cost averaging on the way down, selling on the way up, stuff like that. But ideally, the higher the correlation, the tighter the range can go. But more importantly, the lower the volatility, the tighter the range can go, because volatility measures the actual pool price. More on that when we dive into crypto to crypto liquidity pools. Next thing I like to look at is notable fluctuations, right? So for example, if we see a huge move in the market, like we did over here, 1815 all the way up to 2100. That right there is a 15.7% move in the market, and that happened over the course of February 24th through February 25th, so a day. So I want to make sure that if we see that same exact move, I am not getting kicked out of range instantly, meaning that my max price probably needs to be about plus 15%. Now that seems a little bit extreme, and it seems like this is a broad range, but in theory, this is going to allow us to sit back, relax, and let the pool do the work for us and accumulate more assets. Remember, around here at Metrix Finance, we are looking for investors that want to base their decisions off of data, that want to put the most money in their pocket, and want to take a blue chip passive approach. We are not looking for meme coin gamblers. But we do the same exact thing for the downside. Well, over here, we went from 2100 to about 1840. So we'll do 2100 to 1840. That was a 12% decline. So our min price is now set at negative 15%, so that should encapsulate that 12%. Another thing I like to look at is my asset ratio, right? How much of each asset do I have? 46, 54. Right? This is kind of diving into the E exposure side of the range. We want to make sure that we're comfortable with that. Now, in the current market, I think we're going to continue to go down. So I probably want to have more USDC than Ethereum, meaning I could probably bring this min price down a little bit more to get a little bit more USDC, now weighted 60-40%. And the reason why is because more USDC I start with, that's more buying power to buy Ethereum on the way down in this range. Now, the next thing I will do is I will look at the gain loss trend. Where is the trend headed, right? If we zoom out, we look at 90 days, you can see the trend is downwards, and we are capturing the downwards trend. We're going to go out of range, but we're going to capture the downwards trend. And you can see our current trend, which is somewhat sideways downwards ever since kind of the late January, beginning February stages. We're capturing all of that as well, which means that this range gets a checkbox. Now, obviously, we have to validate the pool, make sure it's a good investment and everything like that, which we won't cover in today's video, but that right there is how you find a crypto to stable liquidity pool range. Now, you can save this to your portfolio on Metrix and come back to it later. I'm going to do so, and then I'm also going to dive into something like Ethereum to wrap Bitcoin, just as a generalized example of how you can select a range for a crypto to crypto liquidity pool, because it's a little bit different. So again, range time span, we want to look at 2 times our intended holding period. So I set that to 30 days. We also want to take a look over at the asset correlation. In this case, this has a correlation of basically 0.96. We also want to look at the price volatility. Remember, lower volatility, tighter range, higher correlation, tighter range. Those two go hand in hand, but they do not have a direct correlation to each other. We mainly want to base decisions off of lower volatility. That's kind of why I'm sharing this framework today, because it's a little bit outdated, but it's still something that we use on a day-to-day basis. We will be updating it for our consulting clients relatively soon. Notable fluctuations, looking at the jumps and the dumps basically. Over here, you could see that we went from a price of basically 32.85 all the way up to 34.3. So we'll just say 32.8, 34.3, I believe it was. Yeah, 34.3. That right there was a 4.5% increase. So can we capture that? Right now, no. So let's move that up probably about plus 5%, maybe plus 4% or so. We'll do plus 4 for now, and we'll adjust accordingly later. Next thing we're looking at is obviously on the downside. Well, we went from 35 to about 33.5. So 35 to 33.5. By the way, we also own Crypto Correlation. That was a strategic acquisition from our company a little bit ago. Proved to be great results. So we'll do about -5 on the downside. Again, this comes down to asset ratios. We have 44% wrapped Bitcoin, 56% Ethereum. Which one do we want more of? Which one do we think is going to outperform? If we think Ethereum is going to do well, then what's going to happen is our Ethereum is going to be shifted into wrapped Bitcoin, which means we want to start with more Ethereum. So let's look at the trend. Let's zoom out. 90 days, you could see that very clearly Bitcoin has performed better than Ethereum because the price is going up. It's taking more Ethereum to equal one wrapped Bitcoin, basically, which means we probably want to wait towards more Bitcoin, basically. So zooming in back to 30 days, we would adjust this range until we have more Bitcoin in our range. So we'd probably bring that max price up a bit, and then we'd probably bring that min price up a bit as well, probably 32.8 or so, and then over here like 36. That gives us about 57% wrapped Bitcoin, keeps us kind of in this area. Now we're looking at the notable fluctuations. So once again, zoom out, look at 90 days, look at the gain loss trend, capturing that. There was this area where we almost went out of range, so maybe we need to do like 32.5 to add a little bit of buffer room, and then yeah, comfortable with exposure, capture the gain loss trend, capture the notable fluctuations. We analyze correlation, we looked at the time span. So boom, check box for the range right over here. And again, we still have to validate and everything like that, but you could save it to your portfolio for now. So that right there is exactly how we select ranges for concentrated liquidity pools. Now I just did a speed run of selecting ranges, but obviously you need to dive a little bit deeper into selecting these ranges, be a little bit more intentional, look at a little bit more data, but hopefully this provides a good and solid framework for selecting ranges in your future concentrated liquidity positions. And remember, you can do this all on Metrix Finance, or you can use another tool. We have a free version, we have a paid version. If you sign up for the paid version, you don't like it within 7 days, you simply just come into the little icon in the bottom right, send us a message and say, I don't like it, can I get a refund? We will refund you as long as it's within 7 days, no questions asked. Anyways, I hope you enjoyed today's video. Again, if you guys want more content just like this when it comes to like validating pools and whatnot and overall strategy, you can subscribe to the channel when notifications turned on. Let us know what you want to see in the comment section. I'll see you guys later. Peace out.